Hello and welcome back to the next episode of Risk versus Reward. As always, we have with us Hari Viswanath, who leads our investment research team. It's called Portfolio. Thank you, Hari. Lovely to have you with us as always.
Thank you, Bharat.
This episode will again dwell on artificial intelligence and the consequences thereof in the stock markets. You may be wondering why we are discussing so much of AI in multiple episodes in the last few months. It's probably the second out of the four that we've done. But that is the flavor of the hour. In the most recent instance, we've had an article by our colleague Nishant Gopalakrishnan, where he talked about how the fortunes, or in the form of stocks, of these AI-centric companies have taken a beating, specifically in the South Korean benchmark indices.
Yes, Bharat. So, on why we are discussing so much of artificial intelligence, see, the whole US market trade has become a AI trade. If you recently see a podcast from Steve Weissman, one of the guys who's famous due to taking short positions in subprime mortgage. He's chronicled in the book, The Big Short. He explains how there is no diversification in the US markets because the much of the index is made up of AI stocks because their market cap is gigantically higher than any other than the other stocks in the index. Much of the debt market too is primarily debt now issued by AI companies. So he says, even if you think you're diversified, you're not diversified. If you're having a 60-40 portfolio between equities and debt, you're exposed to AI stocks in equity markets, you're exposed to debt from AI companies in the debt market. So he says the whole trade is now just one trade, artificial intelligence. So that's why it's important to discuss more of it.
So there's no getting away from AI. Hari, I read Nishant Gopalakrishnan, our colleague's wonderful article on AI stocks, specifically in East Asia, even more specifically in South Korea. And I also liked the way, when we discussed it later, the way you put it, and you quoted Ernest Hemingway from his book, The Sun Also Rises, to a question.
How do you go bankrupt?
Yeah. Gradually and then suddenly.
Suddenly, yes.
So what exactly happened in the South Korean indices? Which are obviously made up of significant weightage with AI-centric companies.
Yes.
Can you take us through that journey? Because they zoomed in value and then suddenly plummeted.
See, the South Korean stock market was probably the best performing stock market, before this crash. But just 50% of the index was made up of just two companies, an entire index. Imagine we have a Nifty 50 and we have 50 stocks. The highest weightage which companies like Reliance and HDFC Bank have had is around 12-13%. Imagine just two companies, Samsung, SK Hynix, make up for 50% of the South Korean index. It's like just two companies in India like Reliance and HDFC Bank making up 50%. That will never happen here, But something like that is what happened in South Korea because such has been the bubble in AI stocks. There are two aspects here. One is, were the stocks expensive from a PE basis? No. On a next 1 year earnings basis, SK Hynix was probably trading in single digits, But there was a massive earnings boom. So you could call it an earnings bubble, So although the PE valuation was cheaper, the earnings was pretty high and probably inflated because in semiconductor, it's always a cyclical story, Your earnings boom and it collapses, So we are now in the phase of a earnings boom. And according to some, it's an earnings bubble. I also believe it's a earnings bubble. So with this in the background, you have to see how two companies made up 50% of the index. And there was a massive rally in South Korea. People got into it. People wanted to get rich fast. I always say this, for example, one of the unfortunate developments post-COVID, the easy money that came in during COVID, right, when interest rates were reduced and more people took to stock markets. While it is nice everyone takes to stock markets, the concept changed to get rich quick. In the 80s, there was a quote linked to economic reforms in emerging markets, especially China. The quote was, "It is glorious to get rich." Where there is economic development and wealth is created, enjoy it. Don't look down upon it, because that was a time when some of the countries were moving away from socialism to capitalism. So in socialism, you look down upon wealth creation. So there was the slogan of "It's glorious to get rich," okay, especially emanating from China, because they started their economic reforms late 70s, early 80s. Since COVID, there has been this phenomenon of it is glorious to get rich quick. Right, it's like earlier the institutions were making money. Now let us retail investors get in. Let us also trade like the institutional investors. If you see what happened with GameStop in 2021, where retail investors actually outplayed institutional investors, they bankrupted a hedge fund. Retail investors created a short squeeze, and the hedge fund went bankrupt. Okay, so that so some of it is good, okay, but too much of speculation driven investing has resulted in it is glorious to get rich phenomenon. That is very unhealthy. That picked up a lot in South Korea. A lot of retail investors got into the markets. There have been massive FII selling in South Korea in year to date. Okay, and retailers have been buying. They were making money from January till June 19th, when the South Korean index Kospi peaked, and since then there has been a 40% correction between June 19 and July 30. So that was the maximum purge period where many investors lost a hell lot of money, because it was not just about buying an index where two stocks made up 50%, which means your diversification is low. There was also leverage investing. Okay, massive borrowing and investing. And then South Korea had concepts like this leverage single stock ETF. Let us say you want to invest in SK Hynix, okay? You can buy the stock. What if someone else offers an ETF which will amplify the returns? Like if SK Hynix goes up 10%, that ETF will borrow, and it will be a 1:1 1:1 ratio. They will borrow, so that will also be invested in the stock. So if SK Hynix goes up 10%, you will actually make 20%. But if SK Hynix goes down 10%, you will lose 20%. Okay, so what happened in, I'll give you one example in this. SK Hynix stock was down 50% from June 19th till July 30th, around 50%. Okay, the single stock leverage ETF that tracks it was down 87%. So somebody who invested in it, you lost all your money. According to a Goldman Sachs report, which was released some time back, the report had data till July 13. Okay, as per that report, roughly 1.2 million trading accounts in South Korea had received margin call. It represents approximately 1 in 3 of the adult population of South Korea. So you can imagine how massive the craze in stocks has been in South Korea. So when it unwound, there has been a carnage.
So fundamentally, there's nothing wrong with the AI industry. It's only a stock market play that has been crazy.
To an extent, yes. But why did the stocks also correct so much? Because there is some concern whether this earnings boom, which I told you, right, can sustain. Okay, there are some concerns developing on the AI economy, some of which Nishant has pointed it out with charts in the article. One thing is that the spread that the debt of the AI companies, like top-rated AI companies like Alphabet, Microsoft, the spread on their new debt that they are issuing is actually increasing. Okay, these are top-rated companies and they have the best credit rating. Okay, and their spread over the 10-year treasury yield is increasing, which means investors are getting slightly nervous on the amount of debt issuance that is hitting the market. The CDS, or credit default swaps, the product that our investors trade in to hedge against defaults, or to bet, like a buyer of a CDS is betting that the chances of default can increase. So that CDS is increasing. So the insurance to protect against default is increasing. Okay, so which means some nervousness is coming in. What happened in South Korea, you could say to some extent it was a retail investor craze, but there is nervousness coming in the AI trade, a lot of which are detailed in the article, if you see.
Okay. So, would it be too much to say that we are possibly looking at an AI bubble, or we are not there yet?
Okay, so everyone is entitled to their opinion. In my view, it is not possible. It is a definite bubble. And in my view, it's a bubble that is worse than the dot-com boom.
My God.
And I will explain why, okay? So the dot-com boom was a valuation bubble. Okay, the dot-com boom was a valuation bubble where valuations went to crazy levels, like Nasdaq price earnings ratio went above 100. And so that is a PE multiple bubble, okay? The 2007 crisis, the major indices crashed over 50%, S&P 500, Dow Jones and Nasdaq. But can you take a guess on what was the PE multiple of S&P 500 at the peak of the bubble? 16 times.
Okay.
16 to 17 times was the PE multiple of S&P 500. Yet it crashed 50%.
Yes, yeah.
Why? Because there was an earnings bubble.
Oh,
The bank earnings, which made up a significant part of the index that time, the bank earnings had shot up a lot between 2003 and 2007 as there was a huge credit boom, primarily housing related. And that inflated the earnings of bank. Then there was a lot of treasury income boom, also trading in subprime mortgages and other activities linked to that. Okay, massive earnings boom. So the PE was only 16 times. So when you look at the PE of a semiconductor stock, the forward PE will not be crazy. It is not 100 and all that. But then some concerns creep in. Is it an earnings bubble? Okay, it's a concern. So that is one thing. Now what you have this time is, you have a valuation bubble and an earnings bubble, in my opinion. Okay, because valuation bubble, because S&P 500 is trading at a trailing PE of 33 times. Dot-com boom, it was around 30 times. Okay, so we are at the peak in terms of S&P 500 when it comes to earnings multiple. Okay, this thing. And then you have earnings bubble. So much of earnings is coming up from few companies. For example, in calendar year 26, S&P 500 earnings is expected to grow by around 25 to 30%. Okay, 34% of the incremental earnings, so roughly 1/3 of the incremental earnings. I will explain in a more simpler fashion. Let us say S&P 500 earnings is 100 now. And let us say in calendar year 26, it will go to 120, okay? 33% of it, which is around $7, okay? $7 is coming from just 2% of the S&P 500 companies, which is 10 companies. 10 companies out of 500 are going to contribute to 33 to 34% of the incremental earnings. So do you see how much depends on so few? Okay, so this 33 trailing PE of S&P 500 can be supported by a forward earnings growth of between 25 to 30% over the next year. But what if the earnings takes a hit? So that is where you have an earnings bubble risk and a valuation bubble risk. 33 times PE is not cheap by any standards. And then I'll come to the third factor. Okay, so much of economic activity is just between the AI companies alone. Okay, cloud business of Google, Amazon is booming. Okay, at the same time, the biggest customers for these companies are Anthropic and OpenAI. These companies are investors in these companies also. Okay, so there is a lot of like, I invest in you, you give me revenue. Everything is legal, okay? But there are risks. I am supporting you, and you in turn, you are giving me business, and you are my biggest customer today. Okay, you are my biggest customer. I am getting high valuation because you are my biggest customer. You are a loss-making company, but you are able to run your business because either there are other investors, and to fund your losses, your cash flow losses every year, either I'm investing or there is money from other private equity investors, and that is keeping you afloat. So my booming revenue, my booming profits depends on your losses reducing or you getting funded either by me or someone else. Now in an economy where, in a global economy where liquidity is tightening, if you actually see the US 10-year yields are consistently going up. Okay, the US 10-year yield is at around 4.6% as of now. close of last week it was at 4.7%. Okay, these and especially the US 20 and 30-year bond yields are at their highest level since 2007. Okay, so you are in a higher interest rate regime. Why is yield going up? It means liquidity is tightening. Okay, liquidity is tightening. That is why yields go up. So as liquidity tightens, your ability to a loss-making company like OpenAI or Anthropic to keep funding themselves reduces, which is why there are reports that OpenAI has deferred its IPO because they didn't get the valuation they wanted. That's a signal that liquidity is tightening. Okay, so in a tightening liquidity environment, the earnings bubble can get hit if things unwind a bit. So this is why I feel it is 100% a bubble. Valuation wise, clearly a bubble when you're trading at 33 times trailing PE. Earnings bubble could be there because profits of companies have been inflated by AI trade. The biggest contributors to earnings growth are companies like Micron, who are selling their memory chips to companies like Google and other hyperscalers. If Google's cloud revenue, see what is Google actually doing? They're building hyperscalers and they're leasing it out to someone like Anthropic and OpenAI. Okay. Now, if OpenAI's funding gets
it's a circular domino effect.
Yes, exactly. Okay, it's a domino effect. So we have to consider the possibility of an earnings bubble and what if both of them collapse. So that is why, in my view, this is a definite bubble. At BL portfolio, in fact, we were the earliest to get into US stock markets in 2020-21 because within our team we have people. I have experience researching on US stocks. Another of my colleagues, Sai Prabhakar, has experience researching on US stocks. So we used to recommend US stocks between 2020 until 2023-24. Since then, we've kept quiet on US stocks because we believe things are getting a bit too hot there, and investors shouldn't rush into the markets and fall for the AI bubble actually.
So it used to be said of the US, if the US market sneezes, India catches a cold.
Yeah.
And now the global markets have such an influence. So my question was to be, what should Indian investors look out for in such a global environment among the stock markets? But also keeping in mind that we haven't had such heavily invested AI companies in our midst.
Yes.
Neither
so,
in the
because we don't have too much of AI companies, we actually, Indian market has been an outperformer in the, when you compare with South Korea and other few other AI themed plays, India has been an outperformer. Okay. So now here is the risk that we have to be open to. Like what happened during the housing crisis when the bubble burst, or during .com, liquidity tightens. Okay, during a crisis, when a bubble breaks, liquidity tightens. Liquidity tightening means flows into capital markets get reduced. Okay, already we've been having an FIA exodus.
Yes.
So we should be open to the possibility that there may be a longer hiatus when it comes to FIAs coming back into India if this bubble breaks, which means the support for your markets is lower. The other thing is Indian markets are not bloated, don't have bloated valuations like US markets. But at the same time, with Nifty trading around 22 times trailing P, I don't think we are too cheap either. We are neither expensive, we are not cheap. So we have to be alert to risks from a liquidity tightening, which can result in lesser support for stocks. So that is one risk. So here is where I want to add one more thing. To your earlier question, I spoke about a valuation bubble and earnings bubble. I just want to leave some food for thought here. I don't want to make a strong statement, but for everyone to explore, okay? There is a possibility that there is a huge boost to GDP only because of AI spending. I mean, the numbers are clear. Okay, but the only thing is GDP has many pulls and plugs. Okay, there is personal consumption, expenditure.
You mean back in the West, the GDP of Western economies?
Yes, GDP of the US, specifically the US. Okay, there is private consumption, expenditure, government. And then you have government spending. All these are components. There are pulls and plugs, different things. Then there are net exports. There are different pulls and plugs in a GDP. Some will be positive, some will be negative, or all will be positive, etc. Okay. Now, here is the food for thought that I want everyone to think about. Okay. Let us assume in the last 3 quarters, AI CapEx has been a significant driver of US GDP. The big techs are spending this year $1 trillion in CapEx. Okay, much of it is within the US. Much of it, we don't have the exact number, but a lot goes within the US. Then there are those neo cloud companies also which are spending in setting up hyperscalers to meet AI computing demand. Okay, now if the US GDP is $100 and the real GDP grew by $2 to 102. Okay, let us assume each of the last 3 quarters 100 became 102. These are numbers I'm giving for example. In this $2 of incremental real GDP growth, anywhere between $1 to $3 comes from AI. The exact percentages anywhere between 50 to 190% has been the contribution of AI related CapEx to GDP growth. Okay. So if this CapEx was not there, you're looking at a significantly lower GDP. There are other things also which were positive, but in each of the quarters, one is positive, another component is negative. This has been consistently positive and has been a huge support to GDP growth. Okay, the US economy is already what many economists say is suffering from a K-shaped economic growth.
Yes.
Okay, K-shaped economic growth where consumption in the top half is pretty solid. They're benefiting from a booming stock market. The wealth effect is supporting their spending. They see they're wealthy each single day. The market is going up despite Iran-US war. US markets reached all-time high yesterday. So despite that, they are seeing wealth only compound for them. When you see your wealth compounding, your propensity to consume is higher. That is what is called the wealth effect, which Alan Greenspan, former Fed chairman who recently passed away, he called this wealth effect as, he said this was a rough take from him, he said a 10% increase in the S&P 500 can increase GDP by 1%, GDP growth by 1%, okay? So the rich are spending pretty well. The bottom half is suffering from in an economy where inflation has been above the target rate for 64 consecutive months, more than 5 years, okay? That is more than 5 years. Inflation has been above target, well above target, and it is getting worse because you have this crude price volatility.
150%.
Most time the spike is resulting in contributing to inflation. And you also have AI-inflation, where increase in chip prices are resulting in your personal computers and mobile phones getting more expensive. That is also adding to inflation. So in this case shape, so you have to understand the importance of CapEx spending by the big techs in an economy in a K-shaped economy. All right. So to your question on should rest of the world be careful, it is precisely because if the US GDP slows down, if their corporates pull back, then there is going to be an effect.
Exports will be impacted.
Yes. So India will have to be careful from the risks of liquidity tightening whenever a bubble, the AI bubble breaks, and then impact to economy due to a global economic slowdown. We hope it doesn't happen, but 4,000 years of economic history has taught us that markets, economies are a cycle, and there is massive craze in the AI, and eventually, yes, you will have the bubble will burst at some time, and when it bursts, everyone has to be ready. The lesson for India from South Korea is be careful with your trading. Okay, invest. See, it's like I said in our earlier conversation, economic reforms based wealth creation, reflecting in stock markets, definitely glorious to be rich, okay? Definitely glorious to be rich. But it is not glorious to get rich quickly. Like many Indians have learnt it the hard way in options trading,
yes,
where SEBI reports have shown how 90% lose money. So it is not glorious to get rich quick. It is glorious to invest well and get rich in the long term.
Patient.
So investors need to factor for the AI bubble unwinding, what impact it can have to our markets. It is unquantifiable, but there will be impact. So invest keeping this in mind. So that's what I wanted to say.
Hari, that was a pretty intense discussion, exhilarating as always. And the message that I take away is that caution to our investors, as we always
Yes,
advise.
caution to caution is extremely warranted now. I think what happened in South Korea will not stay in South Korea if people are not careful.